First entry we're going to take a look at is what would the entry look like if you were the owner of a company and you were contributing cash as capital to the company. Okay, so I think today's the 14th. So we got our date. We'll say last name of the owner is Jackson, and we're talking again from the company's point of view here. So how is the company affected by this? So they're going to get some cash. We'll say it's $20,000, and owner's name is Jackson. So Jackson Capital account is credited for $20,000. Okay, and for my description, I'm just going to put owner contributed capital to company. Okay. Again, as far as the basic accounting equation goes, the left side, you remember the equation is assets equals liabilities plus owner's equity. So remember, every transaction you do, there has to be an equal number of debits and credits, and they also have to balance on the basic accounting equation. So here we have assets going up by $20,000, and we also have owner's equity or owner's capital going up by $20,000. Okay, so that satisfies both of those requirements. I'll go on to the next transaction, which is purchasing some land for cash. Okay, so what would that look like? Again, we'll just say today's date. What account am I debiting here? If I'm buying land. Land, very good. Okay, so we'll say this land is worth $80,000, and I'm paying with cash, so which account am I crediting? Cash, very good. You guys are awake. Okay, bought land for cash, and again, as far as the basic accounting equation goes, this is just me changing one asset for a different asset. So I used to have $80,000 cash. I've now traded that for $80,000 worth of land. So that would be plus $80,000 on the left side of the equation and minus $80,000 on the left side of the equation. So I've still balanced. Okay, next I'm going to purchase some office supplies on account. Okay, meaning I'm not paying for them right now, or I'm going to owe money for them in the future. So what is my debit here? Office supplies. And we'll say I bought $1,000 worth, and my credit is to accounts payable. Okay, so this may look also familiar in a different way because this is the starting point of one of our adjusting entries. So if we bought $1,000 worth of office supplies now on October 14th, when it comes to the end of the year, we're going to have to see how much office supplies we've used during this time period. Because you see, the purchase of office supplies, again, is, as far as the basic accounting equation goes, very similar to the one we just did where we traded cash for land. Okay, but now we're trading basically an IOU for a different kind of asset, office supplies. So we've not recognized any expense in the purchase of these office supplies. Okay, but let's say, and I know that a journal is generally supposed to be in chronological order, but I do want to highlight any of the adjusting entries that we may see on the exam. So say 31st of December rolls around, and we want to say that we've used half of those office supplies. Okay, so what would that entry look like? Debit to what? It's going to be an expense account, so we'll have expense in the title. What do you think this would be called? Supplies expense, most likely. Again, we would normally have our trial balance to look at to see what all the account names are, but that's as good a guess as any. And we would want to show that our office supplies, instead of having $1,000 worth in them, now we want to show a $500 balance. So we need to credit office supplies for $500. No, this is us just showing on the books, recognizing that we've spent that much, or that we've used that much of the office supplies. So let's say that was all paper. We used half the paper, okay? And as we use it, remember, that's when we recognize the expense. So up here, no expense recognized because we just basically, let's say that we had purchased this with cash. We would have just traded cash for another kind of asset. And now down here, we're recognizing that we've used up something. We've actually used up an asset. And so we need to recognize an expense to show that using that asset led to us generating the revenue in this period. Okay, so this is the adjusting entry that you would use to show that much of the office supplies are now gone. So if you did a T-chart for office supplies, after you did this entry, it would show the correct balance at December 31st in your asset account for office supplies. Okay, next. Let's take a look at just straight up earning revenue for cash. Let's say that our company earns $25,000 of revenue for cash. So what should I debit here? Cash. Cash is going up, 25,000. And then I want to recognize service revenue for 25,000. In terms of the basic accounting equation, again, we know that asset has gone up by 25,000, and we know the effect that service revenue has on owner's equity is it increases it. Okay, so on the left side we got assets going up. On the right side we got owner's equity going up. Okay, now we're just going to pay a few expenses with some cash. Okay, so let's say we're paying salaries expense and rent expense. Okay, salaries is going to be for $2,000, rent for $1,000. Since we're paying with cash, we want to credit cash for the combined total of those two, and that's what the journal entry would look like. Okay, and that would just be paying expenses with cash. Okay, now we're going to look at another type of adjusting entry. And this one is accrued revenue. So in this situation, we're going to say that we have performed work for a company, and they, so we've done our job, and they now owe us $30,000 for work that we already completed. Okay, so we're going to debit what? Accounts receivable, because instead of paying us cash, which is what we would normally debit when we earn revenue, they basically gave us an IOU. But we consider accounts receivable very similar to cash. So it's an asset that functions very similarly to cash, and we are going to recognize that as earned revenue. Okay, so that's the adjusting entry to show that we've earned revenue, but we have not received the cash yet. Let's say that down the road, maybe at the end of the month, so we'll say on Halloween, we get the payment for this account receivable. So at that point, we would want to recognize that we've now received cash. in that amount. And we also want to recognize that we no longer are owed $30,000. Okay, obviously these two entries are tied to each other. One happens when we do the work and we basically send out a bill and they owe us money, and the other happens when we actually receive the cash. Now, I know a lot of you, well, maybe not a lot of you, but some of you in this class and in my other class, you wrote down both of these for templates for when you talked about accrued revenue. But then when the questions came up, if I asked, okay, what does the journal entry look like to show that we've done the work, but we've not received the cash yet, a lot of people put this one down instead of this one. Okay, you got to pay attention. It's okay to use the templates as a resource, but you have to pay attention to what's actually going on with each one of those templates. You have to be able to know that this is the template you use. These are what the journal entries look like to show that you have earned the money but not yet received it. And then this is the entry that shows we received the money that we had previously earned. Okay? So you have to be able to distinguish between those two. And that's the same with a lot of the adjusting entries. There's an entry that happens first and then a second entry. Okay? You have to know not only that both of those are associated with accrued revenue, but also which one goes with which action. Okay. So up here, we have this $1,000 accounts payable for the office supplies we purchased. And now in our next transaction, we're going to pay off that whole account payable. Okay? So we want accounts payable to go down by $1,000. So we're going to debit that. And then we're going to use cash to pay that off. So we're going to credit cash. Okay, so what's happening here? We are paying off an account payable. Okay? So whenever we decide to do that, in this case they're happening on the same date, but that's just for ease of recording right now. But usually that would happen down the road a little bit. We go in, we reduce the accounts payable, and reduce cash. Okay? So we have on the left side of the basic accounting equation cash going down. On the right side, our liabilities going down that same amount. Let's see, we already did that one. Okay, let's say that our owner wants to withdraw some money. Okay, so owner's got a big weekend planned. So we're going to debit the Jackson withdrawal account for $5,000. And again, we're looking at this in terms of the perspective of the business. So cash is going to go down by $5,000. Okay. And again, in terms of the basic accounting equation, left side assets goes down by $5,000. This has an effect on owner's equity of reducing that by $5,000 as well. Just the FYI, on the exam, I'm not going to ask you any questions dealing with the basic accounting equation. I'm just mentioning it for all these so that you get it drilled into your head that every single transaction is going to have balance in the debit and credit side and also balance on the basic accounting equation. Let's see. Okay, now we're going to buy a building. Okay, so if we want to buy a building, what asset account are we going to debit? Buildings, probably. This is a fairly cheap building as buildings go, so we'll say it's $80,000. And for the building, instead of paying cash, we're going to sign a note payable with the bank, which is essentially a little bit more formal than an account payable. It's got some more documentation. It looks a lot like just a loan. So we will credit notes payable for $80,000. But just like accounts payable, a note payable is a liability because it's something that we are going to have to pay in the future. Okay, so with this building, we're going to say that since it was so cheap, it's not going to last very long. Okay, so it's probably only going to last, let's say 4 years. Okay, so for each one of those years, we're going to have to recognize depreciation expense. Okay, so what do? We're talking about straight line depreciation. What's the equation that we want to use to find out how much we're going to depreciate this building each year? Well, we take the initial value, the $80,000, and we divide that by the amount of useful life that we think we're going to have. Okay, so we would take original cost divided by useful life, and that's assuming there is no salvage value, which is what we were assuming here. Okay, so 4-year useful life, and we're left with $20,000 per year depreciation. Okay, we bought this building. Let's make that a little easier to calculate. Let's say we bought this building on Halloween. Okay. Now, on the 31st of December, we need to record some depreciation expense. Okay. So we need to determine how much depreciation expense to record for the time between Halloween and December 31st, which is essentially going to be 2 months. Okay, so we already got the per year. So now how do we change the per year to per month? Not a trick question. Say it louder. What? Divide by 12. Yes. Okay, so that's how much it's going to be per month, and we need 2 of those. So I'm just going to round it to 3,333. So we have depreciation expense Okay, so remember, anytime you see depreciation, this is always what the journal entry is going to look like. Debit to depreciation expense, credit to accumulated depreciation, and it may just be accumulated depreciation, or it may specify buildings, equipment, or whatever it is that you're depreciating here. Okay? Any questions on how we calculated depreciation? You will have to do that, something similar to that on the exam. Okay. Let's do a couple more here. Okay, let's say that we got on 14th of October, we are getting a telephone bill for $1,000. Okay, so we haven't paid this. We got the bill, we haven't paid it yet. We just want to record the fact that we're going to owe this money in the future. Okay, or we basically owe it now, but we're going to pay it in the future. So we want to recognize some type of expense. I'll just make one up here and call it telephone expense for $1,000. And probably just going to go with the generic accounts payable here for $1,000. Okay, so again, this is the adjusting entry to show that even though no cash has changed hands yet, we are recognizing $1,000 worth of expense and recognizing that we have that liability. And then somewhere later down the road, we're going to eventually pay that off. And when we do, we'll just debit it out of accounts payable, and we'll credit cash. Okay, this may be the last one. Let's see. Yeah, this will be the last two, we'll say. So now we are going to want to record the fact that someone prepaid us $20,000 for service that we've not performed yet. Okay? I don't think we've done any of those. Yeah. So $20,000 coming into our pocket for service that we haven't performed yet. In the eyes of the company, we are getting $20,000 cash, and we need to record that. So we're going to debit cash for $20,000, and then we're going to credit unearned revenue, which is a liability, for $20,000. Okay, so in terms of our basic accounting equation, we show that an asset cash goes up $20,000 and a liability unearned revenue also goes up $20,000. Okay, this was another one of those questions that kind of has, or templates that kind of has two parts that threw some people off on the quiz, because that's the entry we show when we receive the cash that hasn't been earned yet, and then at some later date we're going to earn that cash, and when we earn it, we're just basically flipping the amount from unearned revenue, and we're going to now recognize it in earned revenue. Okay, so we're going to debit unearned revenue for $20,000. So now unearned revenue has a $20,000 credit, $20,000 debit, which nets out to 0. And we're going to credit service revenue So pay attention again. If you see one or the other of these things being asked of you, you got to make sure that you're putting the right one down. This template for receiving cash that hasn't been earned yet, and this template for once that cash has been earned that you already recorded the receipt of. Okay, so that covers pretty much all of the types of journal entries that you'll see on the exam. Again, there's going to be 20 true or false, and then it's basically going to be, I give you these journal entries, you have to record the journal entry, and that's going to be multiple choice, the journal entry part. Then you're going to be given a set of T-charts that you can record all of the journal entries on, move the balances over to, and then you'll be given some trial balances that you'll have to put the final balances on. Okay, so very similar. It's nothing that you haven't seen before. It's just kind of putting it all together. So the multiple choice will only be journal entries. So these journal entries, like if I said, you received $1,000 cash that you hadn't earned yet. Then you would have 4 choices, and you would have to pick out which one, just like the quizzes. Okay? But then you're going to have to take whatever that correct answer was and use it to fill in the T-charts and everything else. So before you go, basically, my recommendation, the 20 true or false questions, do those. Then you're going to want to print out or have available to you the document that has like the trial balance and stuff in it. That's going to look just like the quizzes did that were paper. Okay? My recommendation is to do those on paper first, and then use that paper to go in and answer the questions on Blackboard. So you have the resource right in front of you. It'll have the number on it, and that will be explained in the little video of how to match the number to the right spot. But if you have it on paper, it's going to be a lot easier, and you're not going to mess up as much as you will otherwise. Okay? Any questions before you go? Do Sunday night at midnight. Anything else? All right, good luck. Email, text, call if you need anything.